Good morning, traders and investors. It is Wednesday, May 21st. Taking a look at the markets, obviously we're seeing markets are trading lower this morning. Nasdaq down 0.6%. Same with the S&P 500. The Russell 2000 down 1%. So I think we noticed this yesterday too. The Russell is down a little bit more. Now, I look at the Russell as kind of the broad market. It doesn't have the same kind of weightings as the S&P 500 and the Nasdaq, which are very tech heavy. And the Russell 2000 taking a bit more of a breather today. So we're seeing a little bit more of broad market selling. I mean, people in general are selling just stocks of all sorts, not just the big Mag 7s or something like that. But in the grand scheme of things, the stock market as a whole, doesn't matter which one we look at. If you take a look here, we've had a pop, a rally, pop, pop and pause. It's stair-stepping its way up. It is having a pause. We can look at the S&P 500. Same thing, series of pauses and rallies. The Nasdaq is also the same thing. And pretty much everything is kind of flirting with a resistance area from when the trend changed. So if we take a look, like for example, at the Nasdaq, you can see here the market was telling us to get out back over here. And now carrying that forward, that is where the market is struggling, where it went from an uptrend and turned to a downtrend. And we were able to avoid the crash, move into a position that could still generate return. And then we've flipped our position and now we're riding up, hitting our first target for the strategy. And now the market is flagging sideways and ready to either reverse back down or to have another pop and leg higher. And the Nasdaq being very tech heavy and emotional driven with people chasing big trades and things like that, we can see the Nasdaq really push and potentially even hit new all-time highs. In fact, if we go back and take a look at we'll just get rid of gold here. If we look at the 2008 market top, the candlestick charts is the S&P 500, more or less. We kind of hit a top and we did poke to a nominal new high, literally for a week. And it reversed and then crashed 57%. The blue line here is the Nasdaq. And simply because it's definitely weighted towards people moving, sentiment of people piling into the same trades, it actually pushed substantially higher than this previous high and before it actually stalled out. So we could see the Nasdaq potentially push even higher and continue to move up. And it tells us that this market is like heavily weighted. So we'll see how that unfolds from where we are right now. Actually, let's just zip over to where we are right now. You can see the Nasdaq's close up to the highs as well. And in the grand scheme of things, I do believe we'll eventually see this market still roll over. But we're going to see the equities market, the Nasdaq, I think, have another pop and push. So just before I touch and show you some other things here, I want to touch on two comments because I see these over and over again, and we get emails on this as well. And so Tammy was asking from yesterday's video, she said, you're long the markets right now and explained it could go either way. But then you said it ultimately doesn't matter. But she goes, but wouldn't it matter to you personally if you're long the markets? And she's just trying to figure out, why doesn't it matter which way it goes? Well, I'm going to explain that in just a minute, but long story short is we've locked in gains. We have stops in place. So if it continues to rally, we make more money. If it rolls over and sells off, we have a protective stop in place. It'll kick us out and then we'll exit the trade and we don't have to worry about it turning into really a loss because we've locked in profits and we have a stop in place. And that leads to another question here as well from Jeff. If we take a look at what Jeff says, he says, I thought stops don't help if it gaps down overnight, correct? The market has been pretty volatile recently, gapping frequently. True, the market's protective stops don't work in overnight trading. Obviously, it could gap down. This is one of the reasons why I love trading the indices is because they don't have like massive life-shattering, altering gaps. It's not like a Tesla or some small cap stock that could gap down 20 or 30%. The indices only will generally gap 1% or 2%. They can have some bigger gaps, but it's very controlled in the grand scheme of things. And the odds of like price dropping down very close to our protective stop and then having a massive gap down below it That is a potential. That is part of the risk of trading. We just have to accept it. It's just the way it is. There is that possibility, but the way we trade, the way we manage our positions, and the assets that we trade, there's nothing life-threatening we need to worry about. A big gap could happen, but it's not going to dramatically affect our portfolio. And the odds of the perfect storm setup, it is possible, but it's very, very rare. So I just wanted to touch on those. If we take a look over at, we're long IBIT, which is the Bitcoin ETF. Again, pop, pause, pop, pause, pop, pause. It's starting to break and starting to on the verge of another move to the upside. URA, which is another one that we're long with one of our strategies. It's got a nice little pause here. It obviously stuck right through this middle of all this resistance. It's primed and ready. And so we're already in positions. We've locked in gains on all of our positions, and we have our stop up in place, so we don't have to worry about what happens from here. And now we're just riding the trend. If the market does pop and extend, all of the positions will push deeper into the money. And if it rolls over, well, then that bounce is done, and we'll end up locking in a small gain and move on and live another day without having to ride prices down and take any losses. And so that's just where we're at. We're at this turning point. A couple of people yesterday said, like, where's the value in this analysis? You're like, it could pop big, it could drop really big. The value is knowing that we're in the proper positions, we're managing our positions, so it doesn't matter what happens, we have a game plan. And if the trend continues in the direction it is in, which for all of our positions is up, then we continue to push deeper into the money. And it's also important to know what the possibility, what could happen. So if we have a big pop and rally today, you'll be like, oh, that's nice. We were expecting that. If we have a big drop, we'll be like, damn it. We knew something big was going to happen, and it went to the other side the way I didn't want it to go, but I kind of knew it was coming. So being mentally prepared for this stuff is the key. That is where the value is. I spoke to a member yesterday, and he said the videos alone, just having the confidence of knowing what's going on, what to expect, he's like, it is priceless because it allows them to not get caught up in the news and all the tariff stuff and just know, like, we're following price. It doesn't really matter what it goes because we manage positions. We're not going to get caught offside for very long if it does happen to go against our overall direction. Other than that, there's not a whole lot going on. Let's just jump through the rest of the assets real quick here. The dollar down a little bit this morning. It continues to flag down and pull back a little bit here as it tries to figure out what it's going to do. Falling dollar means usually rising gold, and we have been seeing gold move up. So we'll see how this unfolds going forward. If this is a multi-wave bull flag and we have that final, potentially another push up to 37.50 for gold. If we take a look at silver, silver's flagging out here on the verge of popping and extending. So if gold does pop and take off, then we're going to probably see silver pop and move up to this 35, 36, maybe even higher. It has potential to go to about 37, 38 if this pattern plays out to the upside. Miners will follow suit. Bitcoin, we've already looked at. And if we take a look over at crude oil, up 1.37% this morning, it's got a little bit of a bull flag, trying to figure out what it is trying to do here. It had the initial breakdown below 65, a huge clean break. It's put in 2 bottoms. It's trying to carve out a bottom here. You could say this is a W formation, which can be a bullish pattern, which this here is also a potential bull flag pattern. That would push it back up somewhere up into this range, up in the 69.70 area, and rally it back up. And the question is, like, how does it hold if it gets there? So we'll just have to see how this unfolds. We have no energy positions, but let's actually take a look at XLE because we were looking at this as a potential inverse trade going back in time. There's a very significant level. I'll just full screen this, get a better view here. We've been seeing this kind of work its way higher with a series of higher highs. Now it's more or less kind of got this on average kind of price breakdown through here. There's going to be resistance through these areas up here. I'll just this will be kind of core resistance. We talked about I was looking for a clean break to the downside. We obviously have that. Now we're into this bounce where it's rallied. It's had a pullback. It's had another rally. It has a pullback. Maybe we get one more push. If the stock market has that one more pop, everything is showing we should have another leg higher. That'll push energy deep into this resistance zone. And then from there, if the stock market starts to roll over and we get a downtrend in the stock market, when we get a downtrend in the stock market, this could be a way to, this could be a very precipitous fall, which means we could play an inverse ETF will be a very strong rally. So that's what I'm looking for. And this is something we were talking about way back over here, saying, listen, it is in nosebleed territory, but we need the crack to the downside. Then we need the big bounce. And then when the bounce starts to roll over and starts to head down, that's when we look for an inverse ETF. I know a bunch of people got into it over here. I sure hope they took some profits off here. And people are saying the trade's not playing out. But believe it or not, it is moving exactly as I expected. Just keep in mind the markets take way longer for things to unfold than you naturally think or feel. So you have to just be patient. Successful trading isn't about finding trades all the time, and your brain will find trades, and they might not be very good. It's just because you want one. But if you let these things unfold and go with the overall tide and the swells in the market, when you time something like this, it can be very, very rewarding. And good things come to those who wait, generally. Let's see what else we have here. I want to touch on a couple quick things. A member was asking about the price spikes. How do we see these price spikes on the charts to understand where they're going? And again, there's certain times when I totally avoid price spikes, and I haven't been feeling them or seeing them on the charts that I really want to pay much attention to right now. But I use the SPY ETF. Show regular trading hours. If you have software, sometimes you have to turn off like price spike filters, all of that stuff. And sometimes the data feeds you get just already clean up the data. They take the spikes out. I think Yahoo Finance or Google Finance free, if you pull up SPY on the 1 minute chart or 10-minute chart, it'll show you actually the spikes with their data feeds as well. I use eSignal and SPY, and I've always seen the spikes. But that's kind of how I go about and see those. Now, the other thing I want to touch on are bonds. We haven't touched on bonds in a little bit. I know a lot of you own a ton of bonds. Most people do, unfortunately. Bonds are still in this downtrend. They're trying to carve out a bottom, but maybe the bottom is not in. We've talked about how I believe this type of price action, this very sharp price action with this bounce, and then this kind of fade here, and I believe it could drag itself out and move its way lower. Now, this is bond futures, but TLT is the same type of thing. I think we're going to continue to see this move down. Let's take a look at TLT. So taking a look at TLT, we've been pushing down to new multi-year lows for a while here. We're poking down. This morning it is set to open sharply lower again. Just based on this chart pattern in the grand scheme of things, we talked about this, the downside potential, if we take this pattern, is around 81. So if we crunch this chart down, you can see price could fall down to this 81 level based on this high momentum play. Now, we could be more conservative and go to where 2 bars or 2 days or just an open or close is usually kind of my more conservative view. That shows you where it could go, which is about 82.50. It's still a long ways down. Percentage-wise, this is going to freak out a ton of people. The market could fall another, that's weird, market could fall about 3.5% from here. That will be, I don't know if that hits new, it's going to be right down to these lows that we saw. Actually, it is going to pretty much pierce, probably break the lows that we saw back in 2023, which is going to send most investors who are with an advisor or just investors who hold a ton of bonds into a panic mode. This is going to feel like they're losing everything. They're on the worst possible trade. And this is where they'll most likely panic and wash out. Somewhere between this 83 and 81 is probably where, if you hold TLT, you're going to be crapping your pants and thinking you should get out. It's just a terrible trade. It is a terrible trade, but this is also probably where it's going to find a reaction low and then have a knee-jerk reaction bounce and recovery. So we'll be looking for this. If this goes into a precipitous waterfall over the next week or so, if you feel that pure panic and you're still holding it, I hate to say hold on to something falling in price, but it's probably going to be an emotional panic low. The fear with something like this is if the bond market and all that does fall apart in a bigger way, I'm worried about something precipitous like this where it just wants to keep on going and it moves. And this is why we don't want to hold things going down. Sometimes it's better just to get out, pick it up later. if you take the loss, you get to use those losses against your gains later. So it's not like you just instantly have a big loss. You get to actually write it off against your good positions, your profits. So it'll knock them down for tax reasons anyway. So that's why I always look at things just like get out of bad trades and get back into it. You'll use that loss against your future gains. So it can still work out fairly well, but people think once you lock in the gains, it's gone. But when you make money back, you can recoup that by not having to pay taxes on all the gains you make on future trades because you get to write these losses off. Other than that, I think that is about it. So yeah, looking at the bond market real quick, I know we had a lot of people wondering about this. So let me just go a little deeper on bonds and yields. Obviously, if yields go higher, bonds generally go down. If we actually take a look at the 5-year yield, you can see the 5-year yield, and I'll just zoom into the shorter term price action. It looks like it's trying to carve out a bottom here. It's got a very sharp double bottom. It does have a rally. Whoops. It does have a series of bull flags. So there's a rally, a tight high momentum bull flag, another rally, a tight momentum bull flag. This could push higher. If that pushes higher, that means bonds are going lower. If we look at the 10-year yield, very similar. Pop, pause, pop, pause. This is ready to pop and explode, which means bonds are about to drop and wash out and put in some type of probably significant low. So definitely bonds are not a play to be holding, and it has been dead money for a while. And the overall picture of the yields are, this is a massive bull flag. I know people don't want to hear this, but it is pointing to like 8.5%. That's like stagflation. Economy slows. We see inflation go up, potential interest rates go up. Let's just take a look at the 5-year. Same type of chart pattern. It is pointing to higher yields, which means you don't want to be in bonds. It means there's a difficult market coming. And everybody says, every time I say 8.5%, everybody's like, the US will go broke if that happens. I'm like, well, every country pretty much is already broke. What's the difference between broke and broker? I don't know. But anything can happen in these markets, and that's why we don't want to fight the trend. This is a very strong bull flag pattern, and everything that's going on, it's going to be interesting to see how it plays out. And we should just follow price, not what we think or feel or don't think is even possible. The impossible is possible, like negative oil. So just keep that in mind. Anyway, that's it for now. Talk to you soon. Bye-bye.